Hi, this is Kurt Jackson. I'm a certified mortgage planner in Liberty, Missouri. And today's video that we're doing is really designed to hopefully help you better understand what's going on when the Federal Reserve cuts rates like they've been doing recently. And since the Fed is on a rate cutting binge, so to speak, it seems that many mortgage applicants have been calling their mortgage representative and expecting a lower interest rate. Others who've been waiting to refinance are puzzled as to why mortgage rates have not moved lower during the recent 5 Fed rate cuts. Now, this is difficult to explain to consumers who have watched a 2.25% reduction by the Fed and not seeing, are actually seeing very little benefit in mortgage rates. Now, the first question I want to ask you is a Fed rate cut really good news for mortgages? And the facts may surprise you. The Fed can only control the discount rate and the Fed funds rate. Now, this is very different from mortgage rates. A mortgage can be in effect for 30 years, while a rate set by the Fed can change really from day to day. It's often said that history repeats itself, and in history, if history is any teacher, we can learn from what happened to mortgage rates the last time the Federal Reserve was in a rate cutting cycle. And the last time they did that for any length of time was back in 2001. So from January 3rd of 2001 through December 11th of 2001, in that 11-month span, the Fed cut the rate 11 times, and 8 of those were 50 basis point cuts. Well, that resulted in a 475 basis point or 4.75% reduction in short-term interest rates. Okay, that took the Fed funds rate from 6% down to 1.75%. Now, most uninformed people would naturally think because the Fed cuts rates by so much during this time that mortgage rates would follow suit and trend lower as well. Well, that wasn't the case. Mortgage rates actually moved higher during this time of significant rate cuts because inflation, which is the arch enemy of bonds, actually rose. Now, let's take a look at what happened with the Fed's most recent rate cutting cycle, which is their first since 2001. Now, as you can see, on September 18th, 2007, the Fed cut the Fed funds rate by 50 basis points. The mortgage bond market briefly enjoyed a knee-jerk reaction to the Fed by closing better that day, but then they lost, or they rates were off 140 basis points over the next 2 sessions. Then on October 31st, 2007, the Fed lowered the Fed funds rate by 25 basis points, and the mortgage bond market responded by having rates go up 78 basis points over the following 5 trading days. On December 11th, 2007, the Fed once again lowered rates by 25 basis points, and in the next 3 days, rates were up 88 basis points. And I'm showing you the correlation there on the screen about how much that equates to in actual interest rates. This past month, the Fed delivered a surprise 75 basis point rate cut on January 2nd of 2008, and in 2 days, mortgage bonds were off 144 basis points, which, as you can see, is about 3/8 in interest rate. So that meant rates jumped up 3/8 in just a 2-day period. 8 days later, as widely was expected, the Fed cut rates by another 50 basis points. Now, the mortgage bonds had little reaction, but they were unable to recover from the enormous, rate jump as seen back on January 23rd, the day after the surprise 75 basis point cut. Now, keep in mind that rates are always moving, so even though they went up after the Fed cut, it's since settled back down some. What we've seen is that rates usually make their moves on the days coming up to the Fed, and it might be the weeks coming up to the Fed meeting. See, the market usually feels it knows what the Fed's going to do, and they've already reacted to it. Unless you see a surprise like we did January 22nd, the January 22nd cut, the market will likely move up after a Fed rate cut until more economic news comes out to help dictate where they think rates will go. So, folks, here's my suggestion. Stop listening to the media about these things because, honestly, they have no idea what they're talking about. And, in fact, neither do most folks when it comes to the Fed and their relationship. And when I talk about that, I mean financial planners, real estate agent, most of your mortgage people. They don't understand those things. What you need to do is find yourself a certified mortgage planner that understands all of these nuances, and they can help you better determine what's going on. Now, on a side note, now that short-term rates are coming down, the adjustable rate mortgages, yes, I did, I use that, that's almost like a 4-letter word now, ARMs, are again looking more attractive. And before you scream at me about how bad they are, remember that when you hear about how bad they are, that's info coming from the media. Okay, and they're not always right on that. So In fact, we found that the conventional hybrid adjustables are actually phenomenal tools if you understand them and have a plan to go along beside them. And I'm not talking about those arms that you've been hearing about on the news that the subprime folks got that are really hurting them now. These are two totally different things. But if you'd like to get more detailed information about your situation, or sign up for our mortgage management program, where we get the information on your mortgage and monitor your mortgage to let you know when it's time that you can save some money, then just contact us at the number on the screen and we'll be happy to discuss it with you. Have a great day. Thanks for watching, and if you found value in this information, please share the link with your friends, family, and coworkers. Have a great day.